Hello class, this is a video tutorial on the pay-as-you-go PAYG tax system. To cover the expected annual tax payment, so this is what we have calculated previously, a certain amount is automatically taken from income statements. The amount taken can be seen on the Australian Tax Office, the ATO, and is based on the amount paid and the frequency of the payments. To keep things a little bit simpler with our understanding for now, we will only be looking at the with tax-free threshold. So to really understand this further, I've taken two excerpts, one from weekly and the other from fortnightly incomes. And this comes straight from the ATO. And it shows here different weekly earnings and how much tax will automatically be taken out from these amounts. So you can see these in income statements. If a person was supposed to earn $481, $19 is automatically taken out from their bank account. So as another example, if a person were supposed to earn, say, $3,370, that is not what lands in their bank account. It is first subtracted by this tax-free threshold amount. After the difference is found, that is the net income, and that is what lands into this person's bank account. Now let's just go straight into two examples. We'll do one in this video and then another in the next, just to really get our understanding developed further about this tax system. So here we go. Now, before we continue, this example that we're about to do makes big assumptions. Firstly, it assumes that this is the amount that this person earns every single week and that they are working and earning every single week of the year. So this is the first assumption that we're going to make just to understand this PAYG system. So here we go. Part 1. Let's take a look at this person's total gross income. So how much income was this person supposed to earn if tax were not applied? Well, this is a little bit straightforward. It's just this amount, $707, multiplied by the times he's paid. Since it's weekly and we are assuming that this person works every week of the year, we multiply this by 52. Let's take a look here. So 707 times 52. So this person is supposed to earn $36,764. So this is what would have landed in this person's bank account if no tax was taken out. Part 2. Let's take a look at how much has actually been paid by this person throughout the year. Okay, so now for this, we have to look at $707 in the weekly PAYG tax tables. So 707, we have it here. So this amount is actually being subtracted by $70 every single week. So to find out how much they've paid throughout the year, it's just going to be that $70 times 52 again, because they are doing this every single week. So $70 times 52, $3,640 is being taken out every single week. Now let's take a look at part 3. Let's calculate this person's net income. Now, a net income, in case you've forgotten, is what has actually landed into this person's bank account. We can easily calculate this for their yearly net income it's just going to be the total gross income, 36764. That is their gross income for the year. And from this, we subtract how much tax has already been paid. 3640. So 36764 minus the tax that has already been paid throughout the year. So in this person's bank account, they would have received throughout the year 33,124. Now, to just really emphasize this, they should have earned this throughout the year. They have already paid this amount throughout the year each week. And so by the end of the year, they would have earned this amount. So this is what has already happened throughout the year. Now, when we get to the end of financial year, this is what we are going to compare how much has already been paid against what is expected to be paid. Now, to do the expected tax to be paid, we have to do two things. The first thing is we always are charged the Medicare levy, which is 2% of your gross or your taxable income. So 0.02, this is the Medicare levy, times your gross income, 36764. So 2% of your gross income, 36764. So the Medicare levy is already $735.28. And then on top of this, we are going to do a income tax. And for this, we need our tax table. So this person has earned $36,764. Let's now apply our income tax onto this. For this, remember, we need to first find which row we are in. With 36,000, we are in this row. So for this, we need to do 16 cents or 16% for every dollar above this amount. Okay, so 16 cents, so 0.16 for every amount above 18,200. So 36764 minus $18,200. So 16 cents for every amount above. So 36764 minus $18,200. This person's income tax is 2970.24. So now for their total expected tax that should be paid by the end of the year, so the tax payable, so remember this is what is expected to have been paid by the end of the year, is just the sum of the Medicare and income tax. So we can add those two. So this is the income tax plus the Medicare. You can see this person is expected to pay $3,705.52. Now, to calculate your tax return, you need to then do what you have already paid. Let's do this in a different color to understand. We have to take a look at your tax paid. And from this, we're going to minus your tax payable or your expected tax. And this is just going to be what you've already paid, 3640. And from this, we're going to minus what you were expected to pay. 3705.52. So 3640 minus 3705.52. This person, unfortunately, is expected to pay an extra $65 to the ATO. So 65.52. So as you can see, this person, even with their PAYG, they are about one incomes, because it's $70 every week, one income short throughout the year. So this person would have to pay a tax debt back to the ATO by the end of the year. But I hope this gives an insight to how a full tax return actually works. So to recap, gross income, your tax paid throughout the year, your net income is just the difference. This is what lands into a person's bank account. And then at the end of the year, we do a tax payable or expected tax, which is a combination of your Medicare tax levy and the tax income based on the income tax table. And for a tax return, we do the difference of what you've paid and what you were expected to pay by the end of the year. So, hope that gave you an insight to this, and I hope to see you in the next video where we cover another income statement for this one. Hope to see you then, and best of luck.